Okay, welcome in. You're listening to the final segment of the weekend edition of the Korelin Economics Report. This particular audio, as most of the audios this week, segments I guess is a better word, is coming from the Hard Asset Conference, about 300 meters. Meters, what am I talking about? I don't even understand what meters means, about 300 feet off of Times Square. Chatting right now with Lawrence Roulston. We're going to talk a little bit about the buying opportunities that exist today. Let me give you a bit of an introduction. I was on a couple of TV shows yesterday, and I was talking about what I felt was a great time to buy resource companies. And one of the hosts was rather adamantly against everything I was saying. He's thinking that this is a bad time to get involved in the resource sector. He was giving reasons for it. I mentioned the fact that our particular portfolio, our being mine and my wife's, is up probably about 15% right now. He was extolling the virtues of treasuries. I kind of looked at him like he was crazy, which I think he was. I personally believe that right now is a great time to be delving into some of the resource companies that are in the exploration sector or in the, let's say, in the beginning developmental stages. Now, do I suggest putting all of our money into that or all of your money into that? I'm not telling you what to do. Remember, this isn't investment advice. I just talk about what I do. Are we putting all of our capital in that? Absolutely not. But we are putting a certain amount of our capital in it, and I'm very, very comfortable there. Variety of reasons that we've talked about on this program before, but let's hear it from somebody else, because remember, my philosophy is you want to get all the information you can, all the different opinions that you can, and then take all those opinions and make up your own mind. Let's see what Lawrence Roulston has to say about this.
Well, Al, I agree with you totally. This is a tremendous time to be investing in these companies. The only question in my mind is, will there be an even better buying opportunity in the coming weeks or months?
Does it matter?
Well, and that's exactly it. You know, I think there's a possibility that some of the share prices are going to get even cheaper over the coming weeks and months. And in fact, you know, you take a broad perspective on it. Probably, you know, a large number of the companies in this sector are probably still overvalued. You know, companies that don't have an asset, that don't have any cash, that have mediocre management.
I'll bet you don't invest in those kind of companies.
Well, exactly. And if I did, I'd be selling them at this time, which is exactly what people are doing. So the indexes, the averages might continue to go down for some time yet, but the higher quality companies are trading at irrationally low values at this time. And it's totally unsustainable. And you know, in the talks that I've given here at the conference, I've pointed out a couple of things that I think are very, very important indicators. And one of these is a chart that's prepared by one of the leading brokerage firms that shows the ratio of price to net asset value for the gold companies compared to the gold price. And without getting into, I hope most people can understand the drift of this, but what it means to say is that gold companies were trading at a premium of about 1.5 to 2 times net asset value 2, 3, 4 years ago. Today, those same companies are trading at 0.75 times net asset value. In other words, whether or not gold is in vogue at the moment, these companies are trading at less than their ability to generate profits. They're trading at a discount to their profit-generating ability. So that's totally unsustainable. They've got to come back to their NAV at some point.
One would think.
Well, they will. I mean, people are bailing out of gold, but there's other people in other sectors that are going to look at these companies and say, this thing can generate profits. It deserves a higher price. Now, another very important measure is the major mining companies at this time are sitting on $100 billion of cash. Never in history has there been that much cash in the mining sector, and that cash is looking for a home. Last year, there was $149 billion of merger and acquisition activity in the mining sector just in the course of last year. That was double the level of 2 years before, and this year is shaping up to be an even better year. The majors have cash, they want to replace reserves, they want to expand their mines, they're looking to the juniors to buy these deposits. And let me throw out an anecdotal bit of evidence. One of the companies that we're following has a 5 million ounce gold deposit, reasonably good deposit in a good jurisdiction. The company has a market value of about $200 million. Okay, that sounds not bad. The company has $205 million of cash in the bank. It's trading at a discount to the value of its cash, and it has a 5 million ounce gold deposit. clearly oversold, and there's examples all through the industry like that of good quality companies that are grossly oversold as the bad companies are being dumped along with the good companies. So you've got to be selective. As I say, it might be months before we get to a point where the industry increases, where we have the media talking about a recovery having taken place in the mining industry. We're probably months away from that. But these companies with good assets, good management teams, with cash in the bank, that are trading at that kind of a discount, those companies are going to start to rebound now. It's happening.
Lawrence, just to interrupt you here for a second, I don't mean to do that, but I think an interesting point. I was in Chicago, speaking at the Chicago Resource Expo here 2-3 weeks ago, and it was very, very interesting. The basic agenda at this particular conference is a panel where the panel is open to questions from the audience, okay, and we had about 5 panel members. I was one of them. We did one day, one the next day. And a couple of my fellow panel members said that they felt that today is a very, very bad time to be investing in the resource sector. They were talking about the huge number of companies that really didn't even belong, in the public arena, et cetera. They were very bearish, and they were saying, we don't expect this sector to come back until at least this fall. Now, I have to tell you, you've been in the business longer than I have in terms of this particular sector. I personally, from my past experience, don't agree with that. I think that now is the time to be picking up companies that you have researched yourself, that you've gotten other people's opinions on. It doesn't matter if you get them at the bottom or where you get them. I mean, sure it matters where you get them, but if you don't pick the absolute bottom, that's okay. They're so low right now, there's got to be buying opportunities.
Well, there's absolutely buying opportunities. And Al, I want to come back to a point you made there, which is incredibly important, and that is you've got to be selective. Definitely, and that's the point I made a moment ago. There's a lot of companies that don't deserve to be in the public arena at all, and certainly don't deserve to be having the valuations that we see now. Some of these companies are going to continue to decrease in value in the coming weeks and months, but other companies that have good assets and good management are going to be appreciating, and those companies are going to start to appreciate now. And I don't think there's a lot of downside risk on those kind of quality companies. And back to the other comment you made, I mean, about the right time to invest, the people that are saying that now is not the time to invest are probably the same people that were saying that you should be investing in gold when gold was closing in on an all-time record high, middle of last year. As gold was approaching $1,900 an ounce, the media was all over gold. Mm-hmm. You heard buy gold from every side.
Yes, you did.
As it was closing in on the all-time record high. Now it's dropped by 15%, and people don't want to touch it. Just look at a long-term gold price chart, the 10-year chart. You'll see it spikes up and it pulls back, and then after it consolidates, it goes back up, and it's continued an uptrend. In the last decade, the gold price has appreciated 6-fold, and it has done that in fits and starts. Right now, we're at the bottom of a pullback. This is the time to be getting in, not after it's had the big run and the media's all over it.
Nobody is able to pick the absolute bottom except somebody who is absolutely full of blind luck. No question about that. Sure, there's people that are going to pick up stocks at their lowest prices, but those people are few and far between. Lawrence, the only thing that I see that could jeopardize the resource sector coming back with a vengeance is if we should have, for example, major economic turmoil. I mean, the economic conditions right now are as bad as I've ever seen them in my lifetime. I didn't live I wasn't alive during the Depression, okay? But, people are on record as saying this is the worst that we've ever seen conditions since the Depression, okay? I would maintain that the only thing that could keep the market from coming back sooner rather than later, that segment of the market that we're talking about, is if, in fact, the sky falls down and the U.S. economy and the European economy falls literally off a cliff, gets even worse than it is right now. I think we're going to muddle around for a while before that happens.
Well, Let's look at this objectively. The U.S. economy, people are still, really depressed about the U.S. economy. It's not recovering as fast as people would like, but it is recovering. We're seeing positive growth. Europe is certainly front and center in the headlines of negative financial or economic news these days. But again, we need to look objectively at this. There's concern about Greece defaulting on the bonds and even pulling out of the euro. Now, let's bear in mind that 70% of the value of the Greek bonds has already been written off. So to lose the other 30% of the value of the Greek bonds, is that going to create a financial disaster? I don't think so.
Psychological disaster, possibly. Ladies and gentlemen, there you have it. A week at the Hard Asset Conference in New York with a couple of side trips to Washington, D.C. Hope you enjoyed the show.